think we'll get started, even though there might be still a few people joining us, but we'll get underway. So my name is Brad Rourke, and I'm with the Williams Group, and been with the Williams Group for 20 years now, just as of July. So I've worked in your your profession for quite a few years. I'm a CPA and an accredited business evaluator, so I feel like I've got some credentials to be able to offer some tax information for you today. So we're primarily going to talk about situations where there's multiple doctors in a practice, and if you're currently a solo practitioner, that's great. But I must say, like, even in our tax practice inside of the Williams Group, it's great to have other tax practitioners that I could talk to, or on your side, professionals that you can talk to about case management, etc. So if you don't necessarily have a goal to have another partner, either associate or ideally another owner, I certainly encourage it, because it's so nice to be able to practice and be able to, yes, in your case, talk about different case managements, different patients, whatever the case may be. So this webinar is going to be about how to ideally structure from a tax and legal entity perspective, how to organize your corporate situation so that you can optimize it for tax purposes and for flexibility. So we in the Williams Group, we help with all those things. On the tax side, because we have a tax practice within the Williams Group. And then Bill Nolan, he leads the transition area. So if you're and Tammy Sup will also help transition new doctors in, structure partnership agreements, just how to bring on a partner, or how to when a partner's exiting. And also on the consulting side, with Rob and Elliot leading consulting, we can determine fairly well. We can evaluate whether or not it makes sense for you to either bring on another partner or bring on an associate, then potentially make them a partner. And so when I say partner, I'm talking about an owner. So there's a lot of good reasons to have, in addition to just how you're practicing professionally within your practice. But then also the benefits of if you get sick or whatever the case may be, there's someone else that can cover it for you. And I know physicians like to practice in different areas, and also can be a exit strategy eventually. You've got more options, I'd say, now within the optometry profession for exiting than you would have, say, 10 years ago, because obviously you guys know that private equity-backed firms have been entering into your space, and so yeah, they want to bring doctors together, so they're practicing together and have associates to work with. So that's the main gist of this webinar, is going to be based on how to structure a multi-position practice. So let me hit my down arrow here. It's not moving the screen. Well, first technical glitch. The guy can't move. Oh, there we go. Good. Yeah, so tax appetite. I'd like to begin with this because it's a concept that's really important. And you guys as physicians understand what tax appetite is from in your profession. So you can look at it as if you have patients that all they're interested in, it could be for very good reason, that they're just interested in a refraction and then corrective lenses, and that's it. Because maybe they don't want to spend the time. Say, for example, if they want to get, which I did, got LASIK surgery, or use Vuity drops, or more aggressive or complicated treatment plans for whatever's ailing them. So you've got patients at all ends of the spectrum that some will just do everything you say. Okay, you should get, whatever diagnosis and the treatment plans you have, they're going to do it because A, they have the time, they see the value in it, and they're willing to pay for it based on where their life is at. Then you might have other patients that just say they don't want to come to the doctor ever, and so they just have essentially have a low appetite. It's the same thing in tax when we're practicing tax. So you've got taxpayers or physicians that have a low tax appetite. So, for instance, they may not want to be bothered. Say, for example, having a home office and deducting a portion of your home, the electricity, the depreciation, all of that, and then let's say the tracking the mileage going back and forth from the clinic to the home office. So some people say, no, it's maybe $3 grand a year of tax savings. I just don't want to bother with that. Just run my tax return and I'm good. So that would be also a lower tax appetite. And then say a higher tax appetite might be, okay, I want to establish my own charity. I want an income split up to my children. I want to have separate entities. I want to make sure on the optical side, I'm splitting out my optical business from my professional business because I know I'm going to get a 20% deduction on the optical. I want to do everything I can to save what I can on tax. And there's obviously there's economics to it also, because you have to take into account your own time. And perhaps you, like, not everyone wants to talk to their accountant. You don't wake up in the morning, oh yeah, I get to talk to my accountant today. That's probably not the first thing you're thinking. So the larger your appetite, the more frequently you're talking to your tax accountant and looking at particular strategies to reduce your income. So it's not like baking a cake, so to speak, that you got the recipe and you bake the cake. That's not how a tax professional works. So it really depends on the appetite of the taxpayer or the physician. So similar to your situation with your patients. And I'll also add that it also depends on the CPA or the physician also, because as you know, as eye care practitioners, physicians, your scope of practice and what you're comfortable with is, you know what that is, and that there's something that's outside of that, you're going to refer that out potentially, or you're going to expand your scope and make the decision on whether or not you want to do that. Same with tax. So yeah, there's areas of tax that, say, for example, as an example, R&D credits. There's a lot of work, and if you're bringing in a new piece of equipment and then you've got to change your workflow and do some planning for that, there's R&D credits available for that. But then there's documentation that needs to occur, there's time involved, and so the economics of it don't necessarily always equate to, yeah, I want to make sure I get every deduction I can. There's economics to it also, because you got to pay your tax accountant, put in the time yourself. So that's the whole concept of tax appetite. So just keep that in mind. So if your tax preparer is not doing something for you or whatever, that you have to consider your own appetite for tax, and then also the tax practitioners, their appetite or their scope of practice. So that's all I'll say on that. So this is just a little bit of an intro before we get into the ideal structure for a multi-position practice. So here's the list of some entity types. Proprietorships, that's not an entity type. So LLCs, limited liability companies, partnerships, corporations, those are state constructs. So what basically that means, which I'm sure you all know, is that if you have one of these, an LLC, partnership, corporation, whatever, it's not you that's practicing. It's you're practicing. Your corporation is really doing the practicing in a sense, because the patient is doing business with the company, and then you're working for the company as an employee or a partner. So the beauty of that, which has made America and many other countries that have corporations to be able to accumulate capital and then not have your personal assets necessarily at risk. So all of these entities, except for proprietorships, do that. So limited liability companies, those are by far the most common. The reason being is they're very easy to get started, very limited filing fees. You don't need to have board meetings. So just the requirements of LLC. So they've become, over the last 20 years, they're definitely the entity of choice. C corporations, very, very few practitioners have C corporations. C corporations themselves, they pay tax. As of 2018, it's 21%. Then when you push up distributions or dividends, you pay another 15%. So your minimum at 21% tax in the corporation, then another 15 minimum when you push it out. So to yourself in dividends. So then you end up paying 37%. So most physicians, most practices have limited liability companies, and they've elected to have their limited liability company tax under subsection S of the Internal Revenue Code. So basically 1300 and above. So that's an S election. So the beauty of an S election and why a S corporation, and I'm going to get beyond this in a moment, because an S election makes a whole lot of sense, or makes perfect sense in a particular scenario. So I'll tell you the reason why the S corporation makes sense is that you can split your income. Let's just say, for example, the clinic is making, it's a single owner, you get 200 grand net at the end of the day. So you can take that $200,000 and you split it. You split it between wages, because you have to take a reasonable compensation. So say you split that out, you give yourself 100 grand on wages. And then on those wages, you pay FICA. And this is the whole idea we're going to get to, is just on how to minimize the amount of FICA and give yourself some flexibility on how to structure multi-physician owner practices. So wages is the worst way to get money out of an entity, because you pay FICA. So as an owner, you pay the 7.65% for the company, and then you pay it on your own wages. So effectively, you're paying 15.3% on every dollar of wages you take out. So even if you get, say, over 200 grand, Social Security phases out at 160. The Medicare component, which is roughly 3%, you include both, that goes on indefinitely. Then if you get up over 200 grand, you pay an extra 0.9% of the Medicare tax. So you're potentially paying, 16%. So it's a large deal. So that's on the wages component. Then on the amount of the other $100,000, this is the beauty of the S corporations, it is considered non-passive income, where you can look at it as if the 100 grand's for your work within the practice, and the other $100,000 that hits your K1 as non-passive income. And it does not attract that 15%. So just rounding the numbers, you can say 15 grand a year. It's not quite that high. It phases out at 160,000. But that's ultimately the benefit of an S corporation. It allows you to save on FICA, 15.3%. So let's just say, for example, if you're taking a $100,000 salary, you push it, you have some basis to only have that 50,000, and take in that same situation where you've got 200,000 income, and you say, oh, my actual work, I built this practice up, and I'm only working 3 days a week, but I'm still making 200K. I'm going to put my wages at 50,000 instead of 100. 15% of 50,000 is 7,500. You're going to save 7,500 every year from having your compensation at the lower rate. So for every 10 grand, you're going to save roughly 1,500 if you're making your wages lower, and then increasing the amount of pass-through income that hits your K1 and ultimately on your. So the K1, you're familiar with that if you have an S corporation or even a partnership. K1, you're going to still get your W-2 wages, then you're going to get a K1 for the difference of that net income of 200 grand. So in this case, if I'm splitting 100 grand of wages, 100 grand goes to box 1 on your K1, and you don't pay the FICA. So that's a perfect situation. So that's with one doctor. It makes a whole lot of sense to be one doctor. It also can make a whole lot of sense also because S corporations are, from a tax perspective, are fairly easy to prepare compared to partnership returns. So an S corporation is also very good, and we advise on this often also, that if you got 2 owners in an S corporation, and they roughly are producing about the same amount. So you've got a $2 million practice, and both the physicians are producing $1 million each. So if you got $400,000 sitting in the bottom line for the whole $2 million, you can split that out, 200 grand each. So you take a portion of that in wages and then a portion of that in your flow through. You're going to save on the FICA. So that's again, that's a great situation. But here's kind of the rub that happens quite frequently is, and it's going to happen eventually, regardless. In that one of the physicians is going to be producing potentially significantly more than the other physician. And if you're in an S corporation, the only way you can get compensation out to one of the owners and pay them more, because when you have the net income at the bottom, it has, so after you pay the wages, you get, say you got net income of $200,000, and then you own the clinic 50-50 with your partner. That $200,000, it gets split 100 grand each. It doesn't matter if you produced 3/4 of that. That's how you're getting taxed on the 100 grand, and the other physician's getting taxed on the 100 grand. Where the economics of that doesn't necessarily make sense. So the only way you can adjust the income is by paying the physician that's producing more, pay them more in wages. But what's the problem with wages? You pay 15.3%. It's the worst way to get income out, like I was saying, because you're paying an extraordinary amount of tax. So here's the magic bullet, so to speak, or the best structure. So let me just reiterate that again. So an S corporation is great, or the S election is great. It's perfect when you've got one owner and you elect the S corporation. Then you can split your income between wages and then try and maximize the flow through income, because you can pay ordinary income tax on that flow through income, but you're not going to pay the FICA. Perfect situation. Second perfect situation is you got two owners, or it could be 3 or 4, but it's harder to get this done. You got 3 or 4 different owners because you've got different owners practicing differently. The more owners, the more likelihood that you're going to have 1 or 2 owners that are producing more, blah blah blah. So if the 2 owners are producing basically the same, or if they're producing something different, and then you're okay with having the income be equal, like 50-50, or increasing your own tax burden, because you're paying FICA, because you have to increase the wages to say push, say in that example, you get $2 million practice, it's pushing $400,000 net to the bottom line that ends up going to the 2 doctors. And then one doctor's producing 75%, say 1.5 million of the 2 million, then really potentially they should be getting 300,000, not should, because they're, maybe the other physician that's only working 50%, or excuse me, producing 500,000 of the 2 million, they could be doing other things, or they might brought in all the patients. There's complications, but point being, the second perfect situation is when the physicians are willing and okay to make basically the same amount of money or pay wages on the excess, which is like I say, the worst way to take out money from a clinic. So here's I'll wait till this slide. I'm going to check my time here. Good, so I'll probably go for 10 more minutes at the most, and then we'll give some time for questions. Okay, so the ideal structure, if you've got a situation where there's multiple physicians and then one or more of the physicians is producing a different amount, or they feel that they should be paid more than the other physician and they don't want to pay the FICA, which who does? We all want to pay our fair share of tax, fair enough, because we live in an awesome country. So, but we're not trying to maximize taxpayers' tax. So the ideal structure is, instead of having your clinic taxed as an S corporation, you have it taxed as a partnership. There's basically 2. You can tax, so LLCs can be taxed as a S corporation. You can elect that, or you can just have them taxed as a partnership. And partnership, all the income it's way more flexible. You can push out the income not based on the ownership percentage, but you can push out the income entirely based on production, entirely based on other factors. You've just got basically the ultimate amount of flexibility. So let's just say one physician gets ill one year, doesn't work at all, then the other physician can take all, 100% of the proceeds, and the doctor comes back in and everything's good. So that's at the partnership level. But partnerships, if you just have the partnership, 100% of the income pays FICA. So there isn't this idea like there is with the S corporations where you can split it and say, okay, I'm gonna take some wages, but the rest of this non-passive, it's called, I don't have to pay FICA on that, not with partnerships. So you might be thinking, well, why would I want a partnership then? Well, so what the ideal structure is to put an S corp in the middle. So you've got you as the physician, the owner. You own your own S corporation, and your S corporation owns the percentage of the partnership. So then you can look at it the other ways, going from the bottom up. So the partnership's making all the money because that's the clinic, that's the entity that's making the money. Say in this situation, $400,000. So now it's got $400,000 to distribute. So rather than distributing the $400,000, and again, you're going to pay FICA on all of that pretty much, you would own your percentage in the operating clinic through an S corporation, and then you own. So each physician would have their own S corporation, and then the S corporation would own the clinic. So the reason why that's the magic bullet is because it provides an enormous amount of flexibility if you've got multiple owners, because invariably you're going to have this discrepancy in production. So then this also goes back to tax appetite. If you don't have another entity in the middle, say your S corporation, same with an S corporation, that's all you got. You got multiple doctors owning an S corporation. All the physicians need to agree on everything, pretty much, because are we gonna pay spouses? Are we gonna pay children? What sort of benefits are we gonna provide to each other? What sort of travel allowances? Everything. You've all got to agree on that. Whereas, like you said, you've got different physicians with different tax appetites. So if you're taking your portion of your income from the clinic, say again, it's that $200,000 is coming your way, two physicians, 200 grand going your way. You can push that up into your own S corporation, and then you can say, okay, in my view, my salary is only going to be 50 grand in that S corporation, so I'm going to pay 15.3% on the wages, or whatever. It's case by case on the amount of wages, but now I have my own S corporation, and I can do with that. My partners can't tell me what to do necessarily with my entity, so I can have retirement plans in there. I can pay children, pay spouses. I could take different travel allowances. I can have my board meetings, whatever the case may be. I get to decide that because it's my company. The clinic at the partnership level is paying my corporation, and then the corporation is going to pay me as the physician, or you as the physician. So it gives you a lot more tax planning opportunities, and then eliminates a few different problems, and that's being the discrepancy in production, the difference in tax appetite, gives you more flexibility in terms of distributions, et cetera, through that sort of three-tier structure. So the downside would be it's not. So partnership returns, so the base level clinic would be in a partnership. And they're a little more expensive to run partnership returns, because partnership returns, tax returns, are based on the operating agreement, how you, as the owners, decide they're going to split up the income. And there's multiple ways to do it. You're not restricted only to wages and then distributions. With a partnership, you can do it, basically distribute the income however you effectively think is reasonable. So a little more expensive for the partnership return at the base level. Then each physician now they've got their own company. They're not just they've got their own company that owns the base level clinic with 50%, 25%, whatever that percentage is. So now you've got a tax return to file, your S corporation tax return, and you've got to run payroll. You wouldn't take a payroll out of a partnership at the base level, because partnerships, there's no wages. S corp is the only time an owner would take wages. C corporations too, but so now you would have to run your payroll for yourself. You can do it just once a year if you wanted to, in your S corporation. So there's some additional costs. Now you've got a little bit more expensive on the base level partnership return, and then you have your added S corp return yourself and the bookkeeping on that. So it might be say $2,000 for the, maybe $3,000 all in to take care of that S corporation. So that could be, if you're saving $10,000 on FICA and all, let's say you have a higher tax appetite, the $3,000 is drop in the bucket relative to what you can be saving from a tax perspective by having the structure. So that's the, in my view, that's the ideal situation if you've got multi position owners. So I think this next, I'll just wrap up here in a couple of minutes. I basically covered this area: balancing ownership compensation between wages and distribution. Ideally, minimize your wages, maximize the distributions with a flow through. That's basically the concept there. But that's case by case. You got to talk to your tax practitioner. Some tax practitioners are because you've got the IRS, and the IRS's opinion, and then but the tax code is based on the Internal Revenue Code, Title 26 of the U.S. Code. What the IRS says mostly is correct, but oftentimes taxpayers take a different position than what the IRS takes, because the IRS position is typically going to be, I want as much tax out of you as I can get. That's their position. But a tax practitioner is going to say, well, we don't necessarily agree with the IRS on this situation. And that's all I'll say there. So with the tax tips, just real briefly. So I guess at this point of the year, you can be looking at, and these are pretty common. So as of 2018, you can deduct all your inventory. So you want to buy some frames through the end of the year, you can deduct all that. And if your tax practitioner has not deducted all your inventory, it depends on your tax bracket too, whether or not you want to deduct it. You can change your accounting policy, your tax policy, and deduct all your inventory. So that's one thing you can do. Obviously, investing in equipment, you still get 100% bonus. You can deduct all your, actually I think it's 80% this year. So Congress is happy to allow deductions if you're investing back in your business. So charities, retirement, there's basically 3 levels of retirement. You have simple IRAs, which are simple, or just IRAs, which give you 6,000 or 7,000, and then these next 2 are company-based plans. You got to offer them to all your employees. So simple IRAs give you 13,000. I think those are the best in my view, because 401ks there's a lot of administration involved in a 401k, and plus you basically get audited every year, and there's testing. So they take pretty big fees out of your 401k, but you get 22,500 this year, I think, and then if you're over 50, there's an extra 5 or 6 grand. So. One thing I would advise you on, a lot of 401k plans have profit sharing attributed to them. And that profit sharing means you're sharing your profits with other staff or other people. So don't think it just because I get the tax deduction because I'm contributing more to my 401k. Yeah, you are, but if the profit share gets distributed basically equally in a sense over all the employees, so it's not a great deal for the owners, but it's great from the perspective that at the end of the year you're sharing your profits with your staff. So that's all good. Yeah, charitable donations, etc. So I guess that's probably all I'll say. We probably covered enough. I'm ready at a half hour. So okay, I think I'll end there. Thank you very much for taking the time. I appreciate it and appreciate the questions. So have a great rest of your day.